Hi, I'm Pattu from freefincal. Today let's talk about an interesting question I received a few days ago. What return should a 30-year-old investor aim for their retirement portfolio, assuming that the retirement is about 25 years away? So let's plot this out step by step. The first step is, of course, already done in this case, because the first step is always understanding why the money is needed and when it is needed. So many people don't even know when they need money. They will start a question saying, I want to invest for 3 years. Then if you ask them a cross question, they'll say, I will need the money in 5 years or 7 years, and keep changing the duration. That's just not on. Unless you're sure about when you need the money, the risk associated with the investment can never be determined. The second step is, of course, to understand about inflation, the power of inflation. In the past, even for a very frugal existence, as I have shown before, 8% inflation was the norm. For extravagant lifestyle, it will be more. But going forward, assuming that inflation in India will gradually decrease over the next 20-25 years, I would still recommend having an inflation of about 7%. This is because there are too many unknowns. For example, we import almost all our fuel and so on. Fuel prices keep increasing. As we speak, the prices are increasing again. So that's always going to be a case. So I would assume that we err on the side of caution and take 7% as the inflation. That's going to be our benchmark. So the return that we get should be benchmarked to this inflation rate. Of course, the return can be anything. You can expect a portfolio return of 5%, 4%, 3%, 10%, whatever you can assume anything you want, provided you have the associated money to invest for it. Of course, you can't expect 15% return from your entire portfolio or 12% return, because that would mean that you have to invest less, but the chances of failure is going to be so much more higher. So the next step is to, of course, understand asset allocation and to appreciate that you just can't be putting all your money into one asset class, into just fixed income or PPF to beat the 7% benchmark, because over the long term, already PPF has dropped from 12% to already it's gone just below 8% now. So that's going to keep going down. It's going to keep dropping down over the next 20 years. So we just can't put all our money there. There's just not enough to beat. We won't be able to beat inflation. We'll be able to more or less match inflation, but even for that, the investment amount necessary would be significant. And of course, you can't put too much into PPF anyway. So I always keep talking about EPF, because even at first of all, they should not be giving 8.5% returns. Even that they are not able to give regularly, because they don't have the money for it. They have to give a much lower return, but that's due to the forces that we all know. They are not able to do that. So EPF also will decrease going forward, and it will have difficulty maintaining that high return. So it's not just on. So from equity, first of all, we need at least 50% equity in the portfolio, and from that portfolio, at least I would say 9% after tax is the lowest return assumption that you can safely expect. Safely means doesn't mean you'll always get it, but at least the chances of disappointment would be less, because we have been seeing, and I've showed this in several videos, Nifty Next 50, Nifty returns have all come down in the past 20 years. So going forward, it's going to go down further. There may be cycles, but it's better to expect that it to go down. So 9% after tax from equity, 6% or so from fixed income would be a reasonable expectation for the next 25 years. So the simplest asset allocation is 50% equity and 50% fixed income. So 50% of 9% plus 50% of 6% gives you your return expectation of 7.5%. This is the initial after tax portfolio return that you will have to consider. Initial, because this asset allocation has to be changed, because you can't hold 50% equity until the time you need the goal, and you have to plan the change in the asset allocation now itself, because if you don't do that, then you will be investing less because you are now planning for 50% equity with 9% return expectation. Sometime down the line it will become 25%, 30% equity, then you will be investing less for that asset allocation. So you have to take that variable asset allocation into the mix right away. There are two ways to do it. One is you can use my robo advisory template, which automates this for every goal you take, or you can learn how to do it in my course, lectures on goal-based portfolio management. Those are two ways I talk about, two places where I discuss two strategies for variable asset allocation. So these are the basic steps which are very important to get started. If you notice, the big mistake that newbies do is they are always talking about where should I invest, and so on. They are not doing any proper planning, systematic planning for that. We cannot be always thinking about products. Products should come last. Product categories should come last. We should first structure the plan according to our needs, and that's what in my opinion is the biggest newbie mistake. So we have talked about how to devise your own retirement calculator. Given all these inputs, given all these assumptions, please check out that video. I have a video on how you can devise your own retirement calculator and do it within about 15-20 minutes. This video is available in English as well as in Tamil in a separate video. So please do check that out. So that's about it. And after that, you need to review it. See, only in the 7th step is the actual product choices. In all these 6 steps where understanding your need, appreciating inflation, having some return expectations, moderate return expectations, devising a asset allocation strategy, not only initially but also later on, then actually create the plan and find out the amount required for that particular goal that you need to invest. Then only you talk about product categories in each asset class. In fixed income, obvious choices are EPF, PPF, VPF, NPS with practically no equity, or maybe the standard small equity exposure that government asset allocations have. Then in equity you have the simplest choice is a Nifty index fund. That's when you have to go through these 6 steps and only then talk about product categories and then products themselves. If you put the products first, you will start trying to define our plan according to those products and make mistakes. Then we will talk about review. We have to do a simple annual review, asset allocation. What is my target corpus after 1 year, after 2 years? Where am I now? Should I rebalance now? Those decisions you take with an annual review. Several readers have joined in to produce annual reviews. I have linked them all in this post. You can check that out in the communities tab. And then once you get this done, so you can start with, let's say, 50% or 60% or even 70%, 80% equity, and then you can, once you get this started, once you start investing, you can ask what is missing. Like I said, you have to devise your own variable asset allocation plan. I have a free seminar which is linked in the description, which is basically which says it's the basics of portfolio construction, again, which talks about this in some detail with a little more examples and so on. So you can check that out as well. Bye-bye.